Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Circle.
If you find our talks useful, please consider subscribe, like, and comment underneath.
And we should probably mention real quick that there is a link for a 14-day free trial of StockOracle down in the description.
Right, yeah. And just as a quick disclaimer, that is an affiliate link, so we might earn a commission if you sign up. Oh, and also any AI insights or, value estimates we talk about today might be wrong.
Always verify the data yourself, exactly. We are here to talk about long-term wealth building, not short-term trading.
Exactly. We want to focus on protecting capital and really understanding the underlying valuation. So imagine you're standing right on the edge of this wild, chaotic frontier town.
Like a gold rush kind of vibe.
Yeah, exactly like a gold rush. People are striking it rich, others are losing their shirts, and there are, virtually no rules. It's totally unbridled. But right in the middle of this frontier, someone is trying to build a perfectly structured, incredibly rigid, federally regulated commercial bank.
Just wearing a tailored pinstripe suit right in the middle of a rodeo?
Exactly. And that tension between the chaotic, wild west of digital assets and the strict traditional order of federal banking is exactly what we are looking at today in this deep dive.
It's such a fascinating dynamic.
It really is. We have this massive stack of research today, mostly anchored by a comprehensive forward-looking equity research report on Circle Internet Group.
And Circle is they are sitting right on the fault line of two massive tectonic plates right now.
Yeah.
On one side, you have the fast-moving, highly volatile world of digital assets, right? And on the other, the slow, heavily guarded machinery of traditional U.S. banking.
It's wild. And the mission of this deep dive is to figure out if they can actually pull off this high-wire act, because Circle is presenting the market with this massive contradiction.
Oh, absolutely.
On one hand, their core product, the USDC stablecoin, is growing incredibly fast. Circulation is up 19% year over year.
Hitting $73.3 billion?
Yeah, massive. But then on the other hand, you look at their stock, and it recently took a terrifying 47.5% nosedive from its 52-week high.
Which was up at $159.47. Though, we do need to factor in the recent sharp rally of nearly 17% over the last 5 days.
Right. Okay, let's unpack this. Why is there such a massive disconnect between the adoption of their product and the total panic in their stock price?
Well, the sentiment around this company is just whipping back and forth violently, which, usually indicates the market fundamentally disagrees on how to value the actual business model.
And for you listening, you might be wondering why you should even care about the internal mechanics of one specific crypto infrastructure company.
You should care because Circle is the ultimate bellwether. They are the live test case for institutional adoption in this space.
Yeah, it's a front row seat to the collision between traditional finance and crypto.
Exactly. If Circle successfully transitions into a federally regulated digital assets institution, it creates a legitimate blueprint for the entire industry.
And if they stumble,
then it just validates the worst fears of every crypto skeptic on Wall Street.
So to figure out if they are going to stumble, we have to look under the hood at how they actually make their money.
And this is where the forward-looking research really flips the traditional tech narrative on its head.
It really does.
Yeah.
Like when I look at a digital infrastructure company, I expect them to make money by selling software or charging transaction fees.
Right, SaaS revenue, stuff like that.
But looking at the numbers for the first half of 2026, Circle's total revenues were $1.395 billion.
Huge top line.
Massive. But the actual service and contract revenue, the money from their core tech, was only about $75 million.
Yeah. The overwhelming majority of their revenue is entirely disconnected from software contracts. It's just interest income.
It's crazy.
Well, to understand why, you have to look at the mechanics of a stablecoin. When a user wants a digital USDC token, they hand Circle a real US dollar.
Right.
Circle mints the digital token, gives it to the user, but they don't just leave that physical dollar sitting in a checking account.
No, they deploy it into cash equivalents and short-term U.S. treasuries to earn a yield.
Exactly.
It reminds me of a casino. Imagine this massive glittering casino where you'd assume the house makes its money from the blackjack tables, right?
Yeah, or the slot machines.
But in Circle's case, it's as if they let everyone play the games for free. And they generate their profit just by taking the huge pile of cash sitting in the cashier's vault, walking it down the street to a bond market, and collecting the interest.
That analogy actually holds up perfectly, especially when you look at the sheer scale. According to the SEC filings, they're sitting on $75.8 billion in restricted cash reserves.
That is just a staggering amount of money.
It is. And they buy short-duration treasuries so they can liquidate quickly if users want their dollars back. When yields are high, that reserve generates the $1.4 billion you mentioned. The yield on the vault basically is the business.
But wait, I have to push back here. From a valuation standpoint, if almost all their revenue comes from interest on those short-term reserves, aren't they just highly vulnerable to macroeconomic shifts?
Oh, entirely.
Because we're entering an environment where Treasury yields are falling. If the Fed keeps cutting rates, doesn't Circle's main revenue engine just start to sputter out?
It does, and that is the exact vulnerability dragging down their valuation. What's fascinating here is that this creates a complete paradox for their stock.
How so?
The research highlights that in the broader crypto market, falling Treasury yields are actually widely celebrated.
Right, because when rates go down, traditional assets yield less, so investors move out on the risk curve.
Exactly. Capital flows into assets like Bitcoin, which, recently pushed back up to $70,000.
Risk is back on the table.
And when Bitcoin surges, market sentiment around crypto equities like Circle goes up too. That dynamic helped drive that recent 16% rally.
Okay, but the paradox is...
The paradox is that those exact same falling interest rates directly compress Circle's fundamental cash flow.
Wow, so the macro trend that boosts their stock sentiment is literally eating away at their actual balance sheet.
It's a brutal tug of war. The retail market is cheering for lower rates because it's great for crypto vibes, while Circle's accountants are probably sweating in the boardroom.
Because their primary income stream is evaporating.
Right. And management is acutely aware of this. The report notes they recently raised their 2026 guidance for other revenue margins to a range of 41.7 to 43.7%.
Other revenue being the actual tech services, the non-interest income.
The games in the casino rather than the vault.
Right. So they recognize the urgent need to diversify.
They have to. They need to prove they are a durable technology platform, not just a rate-sensitive shadow bank.
And scaling that higher margin service revenue is what changes their long-term wealth-building equation. Which brings us to the biggest piece of news in this report. In July 2026, Circle got final OCC approval to form a national trust bank.
That is huge.
For anyone not deep into banking regulation, the OCC is the Office of the Comptroller of the Currency. They charter and regulate national banks.
Getting an OCC charter is a monumental structural shift. Most crypto companies operate in this fragmented, gray regulatory area.
Yeah, getting money transmitter licenses state by state.
New York, Wyoming, California. It's a slow, expensive nightmare.
So this federal charter just wipes out that state-by-state headache.
Yes, it provides federal preemption, one unified framework. But more importantly, it creates a massive competitive moat.
Because they're embedded directly into the federally chartered banking system now.
Right. If you're a massive traditional asset manager like a sovereign wealth fund, your compliance department literally won't let you do business with a state-licensed, unregulated crypto custodian.
The risk of losing client funds is just too high.
But a national trust bank charter ticks all those institutional compliance boxes. It unlocks enterprise-grade custody and settlement that non-chartered competitors simply can't touch.
And we're actually seeing this play out right now with their emerging engine. The research highlights the BlackRock BUIDL on ARC deployment.
Yes, BlackRock being the largest asset manager in the world.
Right. But how does this actually work mechanically? We always hear the buzzword tokenization. But what does Circle's tech actually do for BlackRock?
Think about how traditional finance settles a trade today. Moving a treasury bond involves clearinghouses, custodians, multiple intermediaries.
It takes a day or two to actually settle.
Right, T+1 or T+2. Tokenization changes all of that. It's like upgrading from the Postal Service to sending an email.
Oh, wow.
By tokenizing a treasury fund on a blockchain, you get atomic settlement. The delivery and the payment happen simultaneously 24/7.
No waiting for banking hours.
Exactly. And BlackRock uses Circle's USDC as the stable payment leg for these instant transactions. It's signaling to Wall Street that Circle's pipes are secure enough for institutional capital.
That's the ultimate stamp of approval. And that institutional momentum ties right into the broader legislative environment.
The Clarity Act.
Yes, the Clarity Act. And to be crystal clear to you listening, we are completely impartial here. We don't take political sides. We are just reporting the facts from the forward-leaning research.
Right, just analyzing the policy environment.
Exactly. The report notes that former President Trump has publicly urged Congress to pass this Pro-Crypto Clarity Act, and that political support has been a major catalyst for the sector.
The market always reacts to the probability of regulatory certainty, no matter which side of the aisle it comes from. For years, the biggest dark cloud over crypto has been the Howey test.
The Supreme Court case from the 1940s about citrus groves.
Yeah, that's what the SEC uses to determine if a token is a security. Applying citrus grove rules to blockchain has just caused endless turf wars between the SEC and the CFTC.
It's impossible to build a business when you don't know which agency is going to sue you.
Exactly. If we connect this to the bigger picture, the Clarity Act mechanically resolves that ambiguity. It defines exactly what makes a token a commodity versus a security.
And removing that ambiguity could trigger a sector-wide re-rating.
Institutions on the sidelines would finally have the green light. And Circle is perfectly positioned to be the regulated toll booth they all have to drive through.
Okay, so USDC is growing. They have an OCC federal charter. BlackRock is validating their tech, and there's potential legislative clarity.
Lots of tailwinds.
If all these macro factors are so bullish, how do we reconcile that with a stock that looks completely broken on the charts?
Well, the technicals and sentiment checks tell a much more cautious story.
The report says as of August 20th, the stock was trading at $83.66. That is below its 200-day moving average.
Which means the long-term trend is negative.
But paradoxically, its RSI, the Relative Strength Index, is sitting at 77.09. Anything over 70 is considered overbought.
It's a textbook sentiment clash. The underlying trend was hammered by the interest rate vulnerabilities, hence struggling below the moving average.
Right.
But the recent news about the Clarity Act and Bitcoin's surge created a violent short-term spike. It pushed the RSI into overbought territory before the fundamentals could realistically justify it.
But here's where it gets really concerning from a wealth-building perspective. The single biggest red flag in this entire report is the insider selling.
The metrics there are definitely stark.
Staggering, really. Insiders, executives, board members have made 152 open market sales. 2.1 million shares offloaded.
And zero open market purchases.
Zero. A negative MSPR of 46.61. If things are so great, why are the insiders cashing out so aggressively? It's like the architects of an unsinkable ship quietly buying up all the lifeboats.
Well, we do need some mechanical nuance before we jump to the lifeboat analogy. Corporate insider selling is highly regulated. A lot of this is driven by 10b5-1 plans.
Which are pre-scheduled trading plans, right?
Yeah, set up months or years in advance to automatically sell shares for diversification or tax purposes. It's a routine corporate mechanic.
So they aren't necessarily panic selling today.
Precisely. However, while we can explain away the selling, the true red flag is the denominator of that MSPR equation.
The zero purchases.
The complete lack of buying. If executives truly believe the OCC charter and BlackRock were sending the stock to the moon, you'd expect at least a few board members to buy shares to signal confidence.
That's a very meaningful cautionary signal.
Mm-hmm.
And they also have this massive legal overhang, the pending class action lawsuit from the April 2026 hack.
Alleging Circle failed to freeze stolen funds quickly enough. This really illuminates the existential cost of becoming federally regulated.
Because they're subject to the Bank Secrecy Act now.
And incredibly strict anti-money laundering laws. Banks have strict liability regarding illicit funds. If they accidentally facilitate moving stolen money, the federal penalties are catastrophic.
So their compliance costs are going to skyrocket.
Absolutely. And an adverse ruling wouldn't just be a fine, it would shatter the institutional trust they just built with clients like BlackRock.
So we have incredible tension here. Massive upside potential, but serious mechanical risks. Let's look forward at their optionality. What is the 3 to 5 year blue sky scenario if they execute flawlessly? And just to be clear, this is an optimistic scenario, not a prediction.
Right. In the blue sky scenario, several catalysts compound. The Clarity Act passes, providing absolute regulatory certainty. Global stablecoin adoption accelerates for cross-border treasury management.
The total addressable market just explodes.
Exactly. And the linchpin. They leverage that national trust bank charter to scale enterprise services. They shift their revenue away from interest rates and generate massive recurring software and settlement revenue.
Providing the rails for Wall Street's tokenization.
Yes. If they do that, the market re-rates them. They stop trading as a volatile crypto proxy and start commanding a premium as a foundational financial infrastructure platform, like a Visa or MasterCard.
That's the perfect optimistic scenario. But what's the ultimate wealth-building verdict today?
The analyst's base case is highly disciplined. They rate Circle a 6 out of 10, neutral with a constructive tilt.
Basically, hold your ground and proceed with caution.
Driven entirely by valuation mechanics, it trades at a PE ratio of 42.41.
That is historically expensive.
Investors are paying a massive premium today for growth they hope happens tomorrow. It leaves very little margin for error.
If the Fed drops rates aggressively before their enterprise services scale, or if the Clarity Act stalls, the stock could severely punish investors.
Flawless execution is demanded here.
So what does this all mean for you listening? If you are watching the digital asset space, Circle is the ultimate test case. Can a crypto company successfully cross the chasm into traditional regulated banking without losing momentum?
They're standing right in the middle of that bridge.
Trying to balance falling interest rates and strict legal liabilities against massive institutional partnerships.
And as we watch them try to cross, there's a broader philosophical question to ponder. Circle is expending massive capital to secure these federal charters and partner with incumbents like BlackRock,
Fully committing to the tailored suit.
but as they integrate into the exact framework crypto is designed to bypass, do they eventually just become a traditional commercial bank with a slightly faster database?
Wow.
And if they do cross the finish line as a fully compliant Wall Street bank, does that represent the ultimate victory for digital assets, or the quiet death of the decentralized ethos that made it revolutionary in the first place?
That is an incredible thought to keep in mind the next time you see a headline about stablecoin regulation. Thank you so much for joining us on this deep dive.
Keep questioning the mechanics behind the narratives.
Absolutely. And don't forget to check out the 14-day trial for StockOracle in the description. We'll catch you next time.